the first set of ratios we're going to talk about are the liquidity ratios. Okay, so those are the ratios that allow us to measure how liquid the balance sheet of a company is. Okay, so the first liquidity ratio that we're going to compute and analyze is what we call the current ratio. Okay, so the current ratio is very simple. It's just the ratio of current assets divided by current liabilities. Okay, as a way of illustration, let us compute this ratio for Cablevision and for BE Aerospace. Okay, so let's go here to the balance sheet. Here you can see that you actually have the real balance sheet for Cablevision for 3 years. Okay, what we're going to do is we're going to focus only on the recent year now, for now. But if you're doing this, for another application, like you may want to analyze the liquidity for more years. For our teaching purpose, we're just going to focus on the most recent data. Okay, so let's go here and think about how we would compute the liquidity, the current ratio, right? So that should be really very simple. You have here the data, the most recent data on the company's total current assets, and you have the most recent data on the company's current liabilities. So the current ratio is simply the ratio of current assets by current liabilities, which is 788 divided by 1737. Okay, so this is in a million. So this means that Cablevision has $1.8 billion in current assets and $1.7 billion in current liabilities. So this ratio is approximately equal to 1. Okay, so Cablevision has the same amount of current assets as they have current liabilities. Okay, so now let's go to BE Aerospace, right? Same information. You have the balance sheet for the last 3 years. Okay, let's focus on the latest information we have. Okay, and here you have information on the current assets, current liabilities. Okay, so again we can compute the ratio. Current assets divided by current liabilities would be 1723. Again, this is in millions, so it means that they have $1.8 billion in current assets and 800 million in current liabilities. So you would get a current ratio of approximately 2.15. So here we have done the calculation, right? Now let's think about it. BE Aerospace seems to have a much larger current ratio than what Cablevision has, right? So it's 2.15, significantly larger, right? Does that mean that BE Aerospace has more liquidity than Cablevision, right? Now what we need to do is we have to start thinking about the details a little bit more, okay? And what you'll soon realize is that the main reason why BE Aerospace has this high liquidity ratio is because they have quite a bit of inventory, right? Out of the $1.7 billion in current assets that they have, $970 million is inventory, okay? So let's take that information and think about the following question, right? So why is BE's ratio so high, right? Inventory, does this really measure liquidity, okay, right? Is inventory really a liquid asset? Does this calculation mean that BE has more liquidity than Cablevision has? So what we need to think about is what is liquidity, right? What are we trying to measure, right? And so the notion of liquidity, that's something very important in finance, of course, right? Liquidity measures how easy it is to transform an asset into cash, right? So how fast can we generate cash from an asset? How easy it is? How much cash are we going to get for an asset? Okay, so that's the notion of liquidity, right? So really what we're trying to understand is whether a company like BE Aerospace has sufficient current assets to cover its current liabilities, okay, right? So is inventory really a liquid asset? Okay, so if you think about that, right, of course companies can try to sell inventory, right? If you run into a liquidity problem, you have some inventory, you can use that to raise cash, but you might have problems, right? Liquidating inventory to raise cash is going to disrupt the business. Think about BE Aerospace, for example. The reason they have inventory, right, is because they have to keep seats, aircraft seats, for example, to sell to airlines, right? And if they have to liquidate inventory, that's going to disrupt their business. And in addition, the company may not really get a good price when it does that, right? The inventory, the aircraft seat may be very specific to a particular airline. If you're going to sell that to a different airline, you may not get a lot of cash for that, okay? Actually, there is some evidence in the corporate finance literature. This very interesting paper by Berger, Ofek, and Swary, which was published a few years ago. What these authors did is they gathered data on how much money, the amount that firms were able to obtain when they sold their assets, okay? When they had to sell assets because they were discontinuing operations. So these were companies that went bankrupt, for example, and what they did is they looked at how much did they get for their current assets, right? Intuitively, right, cash, right, is one. Okay, so if you liquidate cash, cash is cash, so they got 1 for that. Receivables, they got 72 cents per dollar. So what this number means is for each dollar of receivables that they had, they were able to raise 72%. Okay, so if they had 100 million in receivables, they raised $72 million in cash. Inventory was the lowest, right? So inventory just generated $50 million in cash out of 100 million, so 55%, okay? So, inventory is somewhat liquid, but it's not perfectly liquid, right? So that's why we have to think about additional liquidity ratios, okay? So we have some liquidity ratios that take this illiquidity of inventory into account, okay? There are 2 ratios we're going to think about. The first one is the quick ratio, which uses only cash and receivables. And then we're going to have the cash ratio, which looks only at cash, okay? You're ignoring even receivables. Since receivables are not perfectly liquid, let's just take the most liquid asset, which is cash, and think about that, okay? So recalculating these ratios using these different measures, what we do, now you have DirecTV, by the way, right? So now you have DirecTV's balance sheet here, okay, in addition to Cablevision. So what you would do, for example, to calculate the quick ratio is just take the first 2 numbers, cash plus receivables, okay, and divided by total current liabilities, okay? And so notice that really what you're doing is you are ignoring everything else that is in the balance sheet. You are assuming that is not liquid, okay? You only take the assets that you know are going to be generating some liquidity for you. That's the idea, okay, of computing this quick ratio. So here you have an example, right? So if you do this for the DirecTV using that data that I just gave, okay, here's what you should find. That the DirecTV's quick ratio should be about 0.9, okay? If you just take cash and receivables and divide by current liabilities, right? So that means that DirecTV has, 90% of its current liabilities in cash and receivables, okay? We're going to talk about later what does that mean, okay? So here are all the calculations using that data, and I encourage you to do it on your own and check to make sure you can get the same numbers. We have the cash ratio, the quick ratio, and the current ratio for Cablevision and DirecTV. We're not going to talk about the BA Aerospace anymore. The reason why it was there is just to illustrate that inventory issue. Now let's compare these 2 companies that are in the same industry. Okay, so those are the liquidity ratios, right? You can see that if you look at this comparison, it's easy to see that DirecTV has higher ratios, has more liquidity than Cablevision has. Okay, since we're talking about that, let's think about the following question: what is a good ratio? Okay, remember the question we are asking is, can the company pay for short-term liabilities without relying on cash flow, right? Just looking at balance sheet items. What that means is that 1 is a reasonable standard to look at. Okay, current ratios should be above 1, right? That means you have more assets than liabilities. Okay, quick ratios should also be close to 1, at least close to 1. Why? Because we don't want to rely too much on inventory, right? So inventory is tricky. So what we conclude is that quick ratios should also be close to 1. Ideally, you don't want your quick ratio to fall too much below 1. The cash ratio, how large the cash ratio needs to be, that's a more complicated question. It depends on how liquid the receivables are and some other considerations. On Module 2, we're going to be talking more about short-term cash management. I think we're going to have more to say about that. But, of course, the general idea is that a high cash ratio is a good thing in terms of liquidity, but perhaps it doesn't have to be quite above 1. Okay? How does liquidity deteriorate? If you see a company with low liquidity, how can that happen, right? When you think about it, liquidity is about comparing short-term liabilities to short-term assets, right? So one way that a company can reduce its liquidity is by increasing short-term debt to invest in long-term assets, right? So if you raise short-term debt and invest in long-term assets, you're going to lower your liquidity. Or if you use up your cash, right? If you take some of your cash to invest in a capital expenditure, you're again going to lower your liquidity. And that's an issue we're going to go back to in one of the examples in Module 2. So this is coming up as well. We're going to talk about one example where that consideration is going to be important. And finally, performance, right? Performance is going to be related to everything. So if a company does poorly, cash holdings are likely to go down, liquidity is going to go down, and the company may have to think about readjusting its liquidity ratios.